Okay. So let's go over these two problems. And I'll even see if I can put them into, I can put them in Excel. Here, these are called them screenshot problems. We'll work on those first. And then you over, copy. Shrink a little bit. Maximize. All right, we'll just, I don't know how much space I'm going to have to use. No, I want to blow. I'll work out this side of it. Okay, good. So question 14 here. All right, so this is a chapter 6 question. The department uses the FIFO method of process costing. Ultimately, we're going to be asking for the total cost of units completed and transferred out. And it looks like we don't have anything done for us. So this is the apex predator of the exam, because chapter 6, that's the G. Chapter 6 is one of the harder chapters, and FIFO is the harder of the two methods, or at least more steps, I should say, which on average makes it harder. And there are three different steps within three different calculative steps we tend to do in process costing. One is calculate TEU, second is calculate the rates, and the third is to apply the rates, apply costs, and that's what it's asking for ultimately. What is the cost of units completed and transferred out? And we have been given nothing, so we're going to have to calculate TEU, we're going to have to calculate rates off of that for both direct materials and conversion costs, and then correctly apply the costs, which has its own wrinkle in FIFO about the beginning WIP costs entering into orbit and eventually making its way back here at this step here. Okay, so let's go ahead and do each of these in order in this spreadsheet. I just organize our plan of attack on the board there just fine, but we're going to do it in the spreadsheet here. So first we want TEU, and TEU equals units completed plus ending WIP equivalent units. Actually, I'll put the minus first. Minus beginning WIP equivalent units and plus ending WIP equivalent units. I'll put those together to help, at the very least, hopefully have a chance of reminding me that when we get to step 3, we need to apply the rates to units completed minus the beginning WIP equivalent units, that special work done this period figure that we use. So I'll put them together there to kind of help me put them next to each other to help me remind that this is the term actually we're going to be multiplying the rates by. Units completed minus the equivalent units that were in beginning WIP. All right, so we're going to have a TEU for direct materials and for conversion costs. And yeah, we'll go ahead and do this. That's fine. So we're going to want to get units completed for each of these. So I'm going to use this little table, these 6 cells, to organize these 3 terms for direct materials and conversion costs. And I'll work up those terms out here. Okay, so let's build a T account here. This is the WIP, but in units. Make it pretty and merge and center it. You can put a border. Because we have 167 units, we have numlock on. We have 167 units in beginning WIP. We added 689 units during the period. I'm just reading from the problem here. And then we have 175 units in ending work in process. And then in this cell right here, we're going to have our units completed. Just working from the raw physical units. Remember, don't slip into figuring out equivalent units or any sort of percent complete. That does not enter into this part of the calculation. You're I like using the T account because I think that helps you remember that we're just trying to balance the T account. Don't equivalentize any units, just physical units as it is right now. And that gets us units completed. So let's pull that over. Okay, that's the units completed for both direct materials and conversion costs. Now, the direct material percent, I skipped over this sentence here, but it says all direct materials are added at the beginning of the process. So that means that once it started, it's 100% complete with respect to direct materials. So these 167 beginning WIP units, they are work in process. They were started last period. They just weren't done before the end of last period. So they are 100% complete with respect to direct materials. And these 175 units, we started them this period. We just haven't finished them. But once we start them, they're 100% complete with respect to direct materials. So they're also 100% complete. Conversion cost percentages are given to us in the problem here. So 48% complete with respect to conversion costs for beginning WIP, 31% complete with respect to conversion costs for ending work in process. Okay, and we can figure out the beginning WIP equivalent units by taking the beginning WIP physical units times the percent for whatever category of cost we're talking about, percent complete. So that's 100% for direct materials here. So the equivalent units are equal to the physical units. It's the same. And we can copy that over. Since I made this reference absolute, so it's still multiplying physical units times now the conversion cost percent complete, 48%. We'll get 80.16. And we'll do the same thing here with ending WIP, just with the ending WIP physical units. Okay, and now in this cell, I will create TEU by taking units completed minus the beginning WIP equivalent units plus the ending WIP equivalent units. Just following the equation right here. All right, so step one is check, done. Our total equivalent units has been figured for using FIFO for our two cost categories. So this is going to form the denominator for our rates, our direct material cost per equivalent unit and our conversion cost per equivalent unit. So I'll do that. Step two, rates calculation. Now with in FIFO, do we remember what's in the numerator? What costs in the numerator? Do we include current period costs, beginning WIP costs? Yes, both, one, the other. For direct materials, for example, let's keep this column going. What would be the direct materials cost in the numerator for our rate under FIFO? Yes, exactly. Just the current period cost. With FIFO, we're going to hold all the beginning WIP costs aside, or put them into orbit, as I say sometimes, because they're going to come back at the very end. Because by assumption, we assume that these beginning WIP costs, the first ones that were in, because they were literally there at midnight when the period started, maybe the first ones out. So 167 of these units completed are these costs. So we're going to push, are these units that were partially complete. So we're going to push the costs associated with that directly over there. If I could draw an arrow, I would, directly over there, and not include them in the rate. The rate is going to be used to figure out cost of work done this period of that 681 and ending WIP. We would end up with some beginning WIP costs in ending WIP. That's not good. That does not follow first in, first out idea. So the way we do that is we only include current period costs in the numerator here. So 6079. That's numerator. $6,079 for conversion. For direct materials, and $5,902 for conversion costs. So just take the numerator, divide it by the denominator, and we get a rate. So those are our two cost rates. And this is, let's make sure we know, this is for work done this period. So these are this period's rates. We only want to apply them to work done this period. That's important under FIFO. Because when we do step 3, we're going to be tempted not to do that. We're going to be tempted to say, oh, 681 units completed times this direct materials rate is going to be the direct material cost of units completed. That's true under weighted average, but it's not true under FIFO. We're going to only include the work done this period. Under FIFO, these 167 were the first ones in, therefore they're going to be the first ones out. So 167 of the 681 is us just topping off those units, topping off that 167 that were 48% complete, doing the 52% of the work that's needed to complete those. And 514 whole units were completed and started this period, are completed and finished. There, started and completed, there's phrasing. And we're going to use this period's rates for those. The way we do that is nice and simple. We want to figure out equivalent units completed with this period's rates. Okay, like I said, we're gonna extract this idea from inside the TEU equation. We're gonna say, well, units completed minus the beginning WIP equivalent units, that 48% of 167 or 100% of 167 for direct materials, is the work we did this period, because there was a certain amount we did last period. Just excluding that, we're excluding that beginning WIP equivalent units. So it's units completed minus the beginning WIP equivalent units. Those are the equivalent units worth of work we did this period, and it's different for direct materials and conversion costs. I threw a lot of words at that, which hopefully helped explain it if it wasn't already clear. But any questions on this step here? Yeah.
So we don't use the TEU here. We just take the units completed and subtract.
Correct. We don't need to use TEU. Once we have the rate, that TEU's job is done. Yeah. I like to mentally think about. I want to remember that the TEU equation reminds me to subtract away beginning WIP equivalent units when I do this. But strictly speaking, it's not because we're doing anything with TEU. I'm just trying to connect dots in my head so I remember it when I have to do it. So if this doesn't help for me to bring up TEU at this point in the calculations, then ignore that I said anything about TEU. Just know that we're doing units completed minus beginning WIP equivalent units. Okay, is that good? All right, so this is we need to figure out what the cost is of these equivalent units completed with this period's rates by multiplying it by this period's rates. I'm going to multiply DM, equivalent units completed with this period's rates, by the DM rate. Done. And we're going to multiply conversion costs equivalent units completed with this period's rates by the conversion cost rates. Okay? Then we add in those costs we took from beginning WIP, and we said we're going to send them into orbit. They'll come back around at the very end, and here they're coming back at the very end. So $334 of beginning WIP direct materials cost and $512 of beginning WIP conversion costs. We need to make sure we add those in, because those were the first costs in. They need to be included in these costs that end up going out this period. So this is going to be the total costs. Okay, any cells you want to see? Or is there a question? That's fine.
I see. Well, I have another question. So if we're doing fast and find ending WIP, that would be the same for FIFO or weighted average.
Yes.
Just take the ending WIP times the rate.
The ending WIP equivalent units times the rate. Yep. Yeah.
Could you go to cells H16, I16, please?
H16 and I16. Just taking the costs divided by the TEU, current period cost, because we're in FIFO. Yeah, so if you open up your exam and you have a cup of water and you see the little ripples going through it, it's because you got a T-Rex problem in your exam like this one here. It was a deep cut there, but I pulled it out. That's good. That's good. Don't let anybody tell you different. All right, let's move on from this one then. Apex predator. I was going off of that. All right, we got a very similar problem here. Looks like it, however, this one is just isolating the step number 3. So let's shrink it a little bit so we can see it all on the screen at once. Okay, that's close enough anyway. So Price Company produces grape juice and continuous process. The company employs a FIFO process costing system. Data concerning activity in January for department of the company are given in the table below. We have beginning WIP cost for direct materials and conversion costs. We have the beginning WIP equivalent units right here. We have the ending WIP equivalent units right here. We have cost rates. So we will never have to do anything with TEU with this problem. You've already started with all the info. We've already started with the step 1 and step 2 done. And we already have all the info from that because we have rates. So TEU is used to calculate that $15 rate and that $4.50 rate, but we don't need to calculate it to answer the question that we're looking for, which is a step 3 question of what is the total cost of units completed and transferred out. Now we have 80,000 units that were completed and transferred out during this period, out of this department during January. Okay, so that is the units completed, just like we had here. In fact, I'd love to kind of grab everything and show just how much is done. So I can fill in so many of these lines here by simply copying over. Our step 1 stuff is done for us, but copy over information. 3,000. Because we're going to want it later. I don't know what the current period cost, but I know what the ending rate was. I'm going to destroy this equation. I'm going to put in the rates they gave me. $15 is the ending rate, and 4.5. I'll get rid of these numbers. We don't know what the current period costs were. But we know that the rates ended up being this. And then beginning WIP costs, 50,000 and 16,000. All right, so this mechanic, the step 3 mechanic, should still work because we need to apply this period's rates to this period's cost, the equivalent units worth of work done this period. So $15 times units completed minus the beginning WIP equivalent units. So 80,000 units completed minus 3,500 beginning WIP equivalent units right here. It says that they're already in equivalent units right there. So 76,500 equivalent units were completed with this period's rates times $15 gives us $1,147,500 of direct materials cost for the work done this period. Okay, we do the same thing here. Subtract from units completed the beginning WIP equivalent units with respect to conversion costs, and it ends up being the same amount for some reason, 3,500. So we end up with 76.5 here again, and we multiply that 76.5 by the 4.5 rate we were given. And that's great. That's the total cost for work done this period, but it doesn't account for the fact that we have some first in stuff we have to move in, put it in orbit at the very beginning, this beginning up cost. We have to add it in. Don't forget, it ends up 50,000, 16,000 just from the problem. We end up with 1,197,500 for direct materials costs and 360,250 for conversion costs for this period. So sum those, we end up with 1,557,750. So this answer right here. And I feel pretty confident that this answer right here is what you get. Let's see. Yeah, 1,491,750. That's what you get if you stop and you forget to add back in the beginning WIP costs or add in the beginning WIP costs at the end. So you'll be tempted to answer this one for that reason. I believe these other two probably involve forgetting to subtract away the beginning WIP equivalent units. I think that's what they involve. double check that. That one right there is if we just multiply by 80,000, which under weighted average is what you would do. You would take the rate, multiply by units completed, and you're done. That's the cost of units completed and transferred out. With FIFO, we have to carve out that beginning WIP equivalent unit space here and not apply this period's rates, but take the costs that are associated with those equivalent units that were done last period and add them in at the very end of the process to make sure that they end up going out. Yep. Yeah. If this problem were weighted average, I could take 1950, the sum of these two rates, multiply it by 80,000, and that's it. Yeah. Mm-hmm. Yeah.
For step one, TEU is just units completed plus EU and
In weighted average, it is, yes. So.
And then step two, you just add beginning and current period costs and divide that by the TEU.
Yes. Yes, exactly. So if it were weighted average, the equation is units completed plus ending WIP equivalent units, and then the rate. The rate is calculated by you sum beginning WIP costs plus current period costs, and then divide that sum by TEU, and then apply costs. If we're talking, you do one of two things. You apply costs talking about units completed, multiply units completed by the rate, and you get that category of cost, direct materials cost per units completed, or for units completed and transferred out, or conversion costs for units completed and transferred out. Or you take ending WIP equivalent units times the rate to figure out the ending WIP equivalent units cost. So the question will be asking you either, like this one, cost of units completed and transferred out, so you just multiply like that. And if it were asking instead for the cost of ending WIP units, you multiply EWIP EU by the rate. And you sum the rates if it's asking for the total. Sometimes I'll ask what's the direct material cost in ending WIP. So you obviously wouldn't sum the rates. You're not worried about conversion costs in that case, if I were asking that. Yeah. I kind of went off on a tangent after you asked the question, but does that?
No, that helps a lot.
Okay, yeah. So drawing the distinctions right here together, I think is worthwhile. That's why I kind of went off on a tangent. I'm like, yeah, let me make sure we've spent two questions here in the FIFO world. Let's not forget, because it is easier, it would be a shame if we forgot and missed questions on weighted average because we were trying to make them harder with our well-developed knowledge of FIFO. So let's make sure we've distinguished it clearly here. Yeah.
Is the phrase completed and transferred out, is that the same as just units completed, or is that different?
It's the same, yeah. I'm a little inconsistent about when I use one or the other. A little inconsistent. I have some consistency in the fact that I think I very commonly use just units completed, that phraseology, when I'm talking about TEU because it's there in the equation. And when I'm asking for the ultimate cost, I usually use the whole phrase, but it means the same thing. If it was completed, then it's transferred out. We don't have any scrap or waste in these problems, so completed means transferred out. Okay. I try to put a box around this so we don't try and apply any of these steps or equations to the actual work we did here. Okay. It's good on chapter 6 there. That's good. Okay. Let's we'll save that. Make sure. Requests. So let's work with that next. Yeah.
So we have two chapters where we talk about price floors.
Mm-hmm.
I think it's like chapter 2 and chapter 10 or something like that. Basically, the only difference between the two is the later chapter has different categories of variable costs. And know that, but for the earlier chapter, they both share the fixed costs required, and that's gonna be the numerator. You
Yep.
divide that by Q. But my question is, the earlier chapter, does that have, is there always going to be plenty capacity for the request? Or are we have to?
The earlier chapter has limited capacity too. Yeah, chapter 3's questions have limited capacity too. So I could make a master equation here. Let's see if I can just figure it out here. The price floor, yeah, no, that's fine. I'll put unit CM. Kind of wandering off. Might not be able to see that. Unit CM equals okay equals okay, I'll put unit sales in here. So ultimately, P equals, if there's a lump sum fixed cost of some licensing or special equipment you have to buy, just include that in F. And then to get the opportunity cost fixed cost of accepting because of limited capacity, which that exists both in Chapter 3 questions and in Chapter 10 questions, it's revenue minus any internal or external variable costs times
Just the lost CM.
yeah. All that over Q plus VI. So with Chapter 3, there is no VE, so we ignore that, and there's just one type of V. With Chapter 10, there's almost never a lump sum fixed cost you have to do to trade to sell your good internally. The company should have all the material and licenses it needs to sell between departments. But you do follow this together. I put this note in here because if you have plenty of excess capacity, then this lost unit sales is 0, even if Q is, there's no such thing as excess capacity. So my point is, yeah, it almost works perfectly as a master equation there. But this will work for both. That kind of works for both floors as a full expression of what we're doing. Does that help map the differences there?
Yeah, and that second half of the numerator, that's just the lost CM.
This is the lost CM. This whole thing is the fixed opportunity cost. Yes. I'm sorry. Yes. The lost CM is the opportunity cost. Yeah. Sorry, I thought you said lost unit sales, which is just this. But yes, the whole thing is the lost contribution margin from accepting the special order or from trading and selling internally, transfer price wise. Yes. Yeah, I have fixed opportunity cost, which is also, you could call it, which is the contribution margin lost from accepting this special order or accepting this internal sale.
Cool. Thanks a lot.
Yeah, no problem.
Can you explain the middle parentheses?
This right here? So here I'm just trying to get unit contribution margin, so I can multiply it by the total number of lost sales to get the total lost contribution margin.
I just don't know what the first three letters
Revenue. Sorry. Yeah, I wrote it. Never recommended the revenue. The price. We'll put it as a. I'll write the whole name. The price we could sell on the external market, or regular paying customers in chapter 3. Yeah, good question. Yeah, I didn't explain that very well. Yeah, I'm tempted to modify the textbook and include something like that in there, some master equation. I worry a little bit that it'll be frightening to see it. P equals F over Q plus V, I think works well enough. I'll think about it, because there's a real argument to be made to say, if you get familiar with this and know what's going on, and you can use it for every problem, it could be a really useful tool. So I might include something like this in the textbook in the future. Yeah. Okay. Yeah.
I have 2 questions that are essentially the same. It's just asking for the cost for the cost.
Mm-hmm.
And it's FIFO. It gives me the work in progress cost for October 1st and the cost added during October with the equivalent units. Do I add those 2 costs together and then divide it by the equivalent units, or just the costs that are added during October?
So the ones added during October are the current period costs, and you said it's in FIFO? So in FIFO, yeah, the numerator is just going to be the current period costs. Yeah. Those ones from October 1st are the beginning WIP.
I don't add those work in progress costs for October 1st.
Right. Don't include those. That's me disguising. That's beginning WIP costs, and those get send to orbit, and come back at step 3. And your question is just asking for the rates, right? So yeah, you don't have to worry about those at all in that problem. Good red herring on my part. I'll pat myself on the back. But yeah. Okay. Other requests? Any specific questions? We can do backflash. Okay. And here's what I think I'd like to do. Let me try to go through the kind of course I was saying of like starting the review quiz again. We'll skip over chapter 6 because we did a lot of chapter 6 just now, and start some chapter 7. We'll get at least some coverage of that, and we still should have plenty of time to hit chapter 8, and that's where the backflash stuff is. So I think that would work to hit that. Okay, so let's do that. Let's go to the final exam review quiz. Let's preview it and go down to where chapter 7 stuff is. Okay, right here, question 15. All right, so this is 7-1 question. Just by where it is, I know that that's the case. This is one of those that you're going to have to use some algebra with. We have 10,000 finished goods units produced. Standard quantity. Right, so let me go back down here. We want to know the actual quantity. All right, so this is the default, of course. Label, as in, we want to know the actual quantity. This is 7-1 question. We don't know it though. We are given a bunch of other stuff and the quantity variance. So let's put in here the quantity variance equation. Quantity variance equals, okay, what's quantity variance? So the lever we have to pull inside the parentheses is quantity, actual quantity minus standard quantity, times, let's see where it is in the mountain range here. We've got price variance over here near actuals. So we've already moved to standard prices. So these two are varying on the quantity, actual versus standard quantity, but they're already at standard price. So That's the quantity variance equation. Or if you have it on your notes, you could look at it and say, oh, there's the equation right there, if you're doing it that way on the exam. I'll move these down. The quantity variance was given to us. It's 18,750. That's what I have highlighted right there on the page. Unfavorable, which means that actual quantity was higher than standard quantity. We used more than we should have given what we were producing. And so positive is what it would end up being. So it's positive, 18,750. Good. All right, we don't know actual quantity. We have standard price, which I've said standard cost. I'm a little inconsistent about how I phrase that. But $3 per pound. That's the standard price. Good, we got 3 there. We need to figure out SQ though. All right, so SQ is based on actual production, but using the standard quantity per finished goods unit. So 10,000 finished goods units actually produced, because we're doing the flexible budget, not the standard static budget, right? We don't want to get mixed up on that. At 10 pounds of a standard per finished goods unit, right? The standard quantity direct material allowed per unit, as in for finished goods unit, is 10 pounds. So we need to have 10,000 times 10, which equals 100,000. All right, good. We can solve this now. We can say 18,750 equals AQ minus 100K times 3. All right, I'll write that out so we don't think K is another variable. All right, 18,750 divided by 3, 6,250. So now we have 6,250. I just divided both sides by 3 to get that 3 away. 6,250 equals AQ minus 100,000. Actually, I'm going to parentheses it all there. And so AQ is simply equal to 6,250 plus 100,000. Right there. Okay. There are, we happen to pull, I don't know if you like this kind of question. We pulled the short straw. Good. We had good luck. If you don't like this kind of question, we had pretty bad luck because this was the 171-1 question we got. Most of them do not require you to do the algebra on these things. They ask you they give you like all these 3 and ask for the quantity variance. But here I gave you the quantity variance and only gave you 2 of the inputs to the quantity variance. Yeah, I couldn't do the straw thing. I'm like, wait, are we doing a good question you want to do or a bad question, short straw? But... Okay, move on. Yeah.
That one.
Mm-hmm.
Is it just process elimination because it's unfavorable, so it would have to be larger than the SQ?
The way I reasoned it out there was simply because I know that it's unfavorable to have the actual greater than the budgeted amount. And so I knew that if AQ is greater than SQ, then this is going to be a positive. The difference between these two is positive. I don't know. Maybe I'm not understanding the question. Is that?
I'm saying that for this specific problem,
Mm-hmm.
of course the answer was the 106, but doesn't it have to be that because it's the only option larger than the SQ?
Yes. You could solve this problem without doing the algebra. You could simply say, is an unfavorable variance. Yeah, that's a really smart way of looking about it. Yeah, there's an unfavorable variance. Yeah. Here, is that what I said the first time?
No, I realized I kind of worded it.
Oh, sorry. I thought you said that I was about to be happy with myself here. No, okay. We know we have an unfavorable variance. And we look at these two numbers right here, 10,000 and 10, and then we can get SQ of 100,000. Okay, well, unfavorable means it has to be greater than 100,000. That rules out all but one question, all one of the answer choices. Yeah, that's a great way to look at it, yeah. I don't know if they'll all work out that way, but this one would have, and even if it wouldn't have, it might have eliminated some of the answer choices and increase our odds. Okay, good point. I don't know. People have to check the film, see if I ever said something like that. We'll leave that as undecided, unverified. All right, let's move on to 7-2 quizzes here. It looks like we have an overhead volume variance question and a yield variance question. This is the advanced standard costing section. All right, so the fixed overhead volume variance. So double check here. I'm pretty sure I've got my terminology right now. Oh, it's not going to be. The volume variance is going to be the far right-hand side that just appears based on fixed overhead. Why did I do chapter 10? Just recency bias there. Fixed overhead changes the mountain range quite a bit, and the volume variance is the far right-hand side part right here that actually goes to the right of the static budget. With the rest of the mountain ranges, we stop at the static budget as the far right. But because it's even a greater fiction from the static budget to take a fixed cost and apply it based on volume, we push that even further into the hypothetical land, further to the right. And then the math and geometry works if we do that. So fixed overhead variance, we need to, here's the static budget amount, and we need to subtract away the amount applied. It's not harder than that. We can, if we remember, either we wrote down the equation of volume variance equals actual cost driver times PDFOH, which is, I phrase it, if we remember that it's static budget minus applied cost, I'll say it that way. I want to get into that right now. Or remember the mountain range part of it, then yeah, we can simply take these two numbers, subtract them, we end up with 30,000, and it looks like moving into the static budget, moving towards reality from applied costs. It's going higher, going up from 1.47 million to 1.5 million. That's a $30,000 unfavorable volume variance. Okay, I think I need to work on that equation. I wasn't even, I'll look at it and then maybe I need to even fix it in the textbook there. I know chapter 7 needs some work. All right. Any questions on that one? If it were asking for spending variance, it's also very simple. It's the actual costs minus the static budget costs. Right there. Actuals minus static budget. Spending variance. So this style of question for the overhead costs, where it gives you all three and just hopes you know which ones to subtract, so it's pretty easy if you know which ones to subtract to get the particular variance it's asking for fixed overhead. Not a bad draw. Okay, yield variance. Oh, we didn't do anything for the fixed overhead variance. Yield variance. All right, if I'm doing yield variance questions, I'm going to have the yield variance equation written in my notes. Actual yield minus standard yield times standard price at standard mix. All right. So the question gives us actual yield, the finished goods we actually completed, gives us the standard price, standard input price per finished goods unit at the standard mix. So that's 370. That's just the SP at standard mix right there. So what I have to do is figure out the standard yield. Okay, well, if we actually used 111,623 input units, and our standard is to have 5 of these input units go into each finished goods units, then we can divide this number by 5 and figure out how many finished goods units we should have had, our standard our standard yield from this number of input units. So 111,623, 5 standard inputs per FG unit. This is the actual input units. So this would be our standard yield. Okay, I'll copy down the other information that was in the problem. Actual yield was given to us. This is the SP at standard mix. So I'm just going to take these two, I need to put parentheses in, subtract them and multiply them by the 3.7, just following the equation right here. Actual yield minus standard yield, yeah, I got the word right there, times standard price at standard mix. that should be our number. And the question isn't asking this, but in case there's another question that's asking us, is this a favorable or unfavorable variance? Yeah, it's kind of a tricky one. It's the opposite one, right? This is a favorable one, yeah. We're used to positive variances being unfavorable. This is the one where that's the opposite, because we have held constant the number of input units, and we're saying, did we exceed the number of output that we expected, or go below the level of output we expected given that fixed level of input units? So if we exceed it, it means we got more bang for our buck. We got more output units for input units, less waste somehow, or less waste is what that means. The traditional quantity variance says we're going to hold constant the number of finished goods we have and move up and down the number of inputs we put in. So we got this number of finished goods units. Did we use a lot of inputs? Then that would be unfavorable. So that's positive. The difference between that's positive. Or we use very few inputs compared to what we would have expected for this number of finished goods units. That would be a favorable, and it would be negative. That's the typical. Instead, we're holding constant the input and moving up and down actual, in this case, actual finished goods versus the standard finished goods we're expecting. Okay, so positive is going to be favorable here for us, and rounded to cents already for us, or ended up at cents. Questions on that one?
And yield variance is still part of that chapter 7-2?
Mm-hmm. Yeah.
Did you say it's favorable because the actual yield is bigger than the standard yield?
Yes. Yes. If you look at it that way as well, it's logicking it out. Standard yield, as long as you got clear in your head what yield means, and you don't mix that with the traditional 7-1 quantity, then yes, that will work perfectly. We got a lot more out of our process than expected. Yeah. Okay? All right. All right, so let me skip over this for a second. We can come back to it if you want. But let's make sure we hit some that are the backflush questions, which was a request, right? So here's a direct costing backflush question. I think we'll probably find a throughput accounting backflush question a little later here. Yeah, there's a throughput accounting backflush question. So we'll make sure we hit these two in particular. We can probably get this one in as we go along. Won't take too long. All right, so Lava Pocket LLC uses backflush costing to assign product cost to inventory and values inventory using direct costing. Okay, what does that mean? What that means is all inventory costs, inventoriable product costs, are accumulated at the cost of goods sold account. At the end of the period, backflushed. And what are the inventory product costs? Well, using the direct costing dictionary, only direct materials, direct labor, and variable overhead are product costs that we're going to accumulate at cost of goods sold and backflush out. Okay, so that's what all that means. All actual amounts are equal to budget amounts. Firm has no fixed overhead. Okay, it's just simplifying assumptions and statements right there. And we have our totals for the three product cost categories under direct costing. And we have a total units completed right here, which serves as our denominator. All right, so let's go ahead and jump in there and just just for fun anyway. We got 500,000. We'll do all three. Might be doing extra work here. 2,000 units is our denominator. Oh, divided. Excuse me. This is our DM rate, our DL rate, and our VOH rate. So we incurred $250 per unit for direct materials, $75 per unit for direct labor, and $50 of variable overhead cost per unit. Okay, great. We have 350 units in finished goods inventory and 250 units in process. Firm does a count of raw materials and finds 0 raw materials in inventory. So the portion of RIP equals 0. I'll change that. That's 0 is the portion of the RIP entry. We're not going to be backflushing anything for the raw materials part to the RIP account. Which of the following is the cost backflushed to the RIP account? So this firm uses a RIP account, a conversion cost account, and a finished goods account. All right, so there are 250 units in process. And basically what that means is we've split those 250 units in process into their direct materials that goes into the RIP account, plus the portion, and the in-process conversion costs. That's how these accounts are set up now. So it's asking simply the direct materials component of these in-process units. 250 units in process times the direct materials rate of 250 plus the portion, which is 0, but just for completeness, we've kept it in there. So that should be 62,500 there. Yeah.
So in process is just the direct materials.
The RIP account is just about direct materials. And it has the in-process direct materials and the raw direct materials, but we had 0 raw direct materials.
Or else we would add that in.
Or we do add it in. We add the 0 to no effect, but we do add it. But there tends to be, at least as lean accounting is presented in the textbook here, which again I tried to hit center of gravity of what lean accounting is in practice. It's a very varied practice out there. They like to change the inventory accounts to be primarily about timing to being primarily about cost category. So the RIP account is all direct materials account, all direct materials costs. And the conversion cost account is all of the in-process conversion cost, labor and overhead. The overhead that counts as a product cost anyway, that we're doing. Instead of the typical, which is having a direct materials or raw materials count, which is about all the direct materials that are still in process, and then having a WIP account, which is all the direct materials, labor, and overhead of units in process. So it's all about the timing of where those accounts sit. With lean, we're changing it to RIP, which is more like RIP DM account. It's strictly about materials, raw and in process, and conversion costs to separate them out. Yes.
I was going to ask, for completion's sake, can we see what it would be for the conversion cost and the units counts?
Yes.
Because I know sometimes, like in the
Oh.
there was a couple where it was like they wanted all of them.
Yeah, so this is the debit to conversion costs to backflush. Well, if I could spell it. So the units in process times the, times both those rates, conversion costs are DL and VOH. So the units in process times the sum of these two rates. So that's the debit to the conversion cost account when we're backflushing. And then we have 350 units in finished goods. So we're going to multiply that 350 times, well, they're finished, so, and it's a completed category, so we're going to include all the costs together. I don't know if I can say that. I hope saying that makes it remembered better. So that should be the debit to finished goods for backflush.
And then we'll credit
this, and this, and this. Yeah, this company here is not doing lean very well. They have almost almost a third of the cost they have incurred getting back flushed into the inventory accounts. A lean practitioner would say, no, you need to have much less cost in your inventory accounts. You need to be pushing things through much more just in time. So you eliminate some of those obsolescence and insurance and warehousing and shrink costs that are associated with inventory. Yep.
What did you multiply the 350 units and finished goods
Times the sum of all three rates.
In throughput, there's just no conversion.
Yep.
Backlash.
That's right.
That's what the difference.
Yep. There's no debit to conversion costs, and this, if this said throughput accounting, this would be 350 times just the direct materials rate.
Oh.
That is the other. I won't say it's the only difference that there's no conversion cost, because there is that also difference. So let's look at a throughput question here, if that's okay. All right. So this firm, it's asking it a little differently. It's asking about the correct balances for the COGS account before and after inventory costs are backflushed. Okay, so, all right, just for process of elimination, I'm pretty sure it's that one. Because I'm probably being tested on throughput versus direct costing. Throughput recognizes far fewer categories of cost as being product costs. So far fewer of those costs are being stored in COGS before. So I would expect it to be the 9,000 before instead of the 31,500. That's probably if we included all three categories of costs, or direct materials and direct labor or something like that. And they're $20 difference, and that happens to be the raw materials at the end of the period. So I bet this answer forgot to debit out that $20 to RIP when it was backflushed. So I feel pretty confident that that's the right answer there, but we'll go through it just in case. All right, so we use backflush costing, we use throughput accounting, and we have rates here. All right, well, we can still use that. I don't think I've gone over a problem exactly like this, although you certainly saw it on the 8-2 quiz. It's a good number of you did anyway. So this is throughput accounting question, COGS before and after. So we have a $5 DM rate per unit, which means that given 1,800 total units, it means our total direct materials cost was $9,000. And so during the period, we accumulated that cost in the cost of goods account. And that's the only cost we consider a product cost under throughput accounting. They're very strict about this. All the others are direct labor. Any overhead is all considered a period cost, so they want to look at it as a period cost anyway for decision-making purposes. Okay, great. Now we have 10 units in process and 20 units in finished goods. No, I don't think I saved any time with that copy. Hold on. And we can multiply those by the DM rate to see how much how much cost is going to be backflushed to those two. This is the in-process portion of the RIP debit, and this is the finished goods debit. The debit to finished goods going to be backflush. Just taking the number of units times the dollar rate for direct materials, and it's the only inventory cost we're considering. Makes it much simpler. The number of finished goods units times the dollar rate again. And let's add in the portion of the RIP debit, which the problem here says is $20. And we can sum these three, and that's total debits out of COGS when backflashing. For backflash, let's say it. All right. So that's why it's 88.30 right down there.
So for throughput, you're just looking at your DM costs and you only have to worry about your RIP and finished goods units counts.
Mm-hmm. Yeah. And that finished goods account is valued using the DM cost only. Yeah.
Right.
Okay. Well, for completeness here, let's look real quick at this. A firm budgets that a particular machine will produce a total of 19 units per every hour. Due to failure to implement lean practices, well, that's not biased at all. The machine produced only 18 units per hour. The machine requires some downtime every day. What is the efficiency waste of the machine per day? Anybody remember off the top of their heads efficiency waste? What that means? Yeah, I'm 99% sure that's right. We'll double check. Yes, budgeted minus actual capacity. What we actually did. So we budgeted 19 every hour, actually did 18. So the hourly efficiency waste was 1 unit, but it's asking per day. So 24 units is the efficiency waste. If it said anything else here, budgeted waste, management policy waste, rate-based waste, we would not be able to solve the problem because we don't have enough info for that. Yep.
24, even though it says that the machine requires some downtime every day?
Yes. Even though it requires some downtime every day, we're only going to incorporate that fact into these theoretical kinds of capacity calculations. Its downtime every day is already incorporated in we likely budgeted in 19 units per every hour to incorporate the fact that it has some downtime. We probably I would assume we didn't budget it running all the time, even though we know it has downtime. And certainly the amount it actually produced includes the downtime that's required. It can't otherwise. Otherwise, it wasn't really required downtime. So yeah. Even though that last sentence is there, we can get away with efficiency waste being 1 unit per hour, 24 units per day. Okay. Well, let's see if we can pop real quick through some chapter 10, and then we'll call ourselves having finished the review quiz review. And then Thursday, we'll just work on requests. So real quick, we're considering a project based on ROI only, it sounds like. We're asking whether or not we're going to accept it. ROI question, whether the manager will accept it. All right, so this project has 93.5 million profit and 550 million investment. So the ROI is the quotient of those two, or 17%, and it falls right in the donut hole. It's below the manager's current ROI, but greater than the cost of capital. So the firm would be like, yes, 17% is good. The manager's like, no, 17% is bad. So is the manager likely to accept the project? No, it's one of this. It's either this one or this one, and it's this one because the manager cares about current ROI, at least using economic theory, that's true. And the ROI is not less than the cost of capital anyway, so this would be untrue. So it's this one right here. Good. Shortcoming of residual income is got to be because of its size. So size differences aren't factored in. Here we go. Higher residual income might only indicate a larger but not a better performing department, which is why residual income is not used independently typically. It's used in conjunction with ROI to fill the donut hole of ROI, but it has that comparability problem. All right. We'll race through this real quick. Let's see. Do one of these. It's faster. Let's do this one. Wait. They're both direct method. either way. All right, direct method, B to Y. We'll do it in less than a minute here. B has $80,000 of cost. Y consumes 200 units of B's work. We're using the direct method, right? So only 250 counts as the denominator. Oh, wrote it wrong. 250. So 80% of that 80,000 goes to Y. Nice and quick. That 250 comes from summing the work done for production departments. Right there. Okay. We got another B to Y here. It's going to be that 100,000 times 120 over 200, which should be right about here. I think that's the right answer there. It's not going to be less than 50% of the 100,000. It's not going to be over 100,000. Yeah, that's the one left.
If like say we step down
Mm-hmm.
thousands of Department A's cost came from helping out Department B, then Department B would have 150,000 costs.
Yes, yeah. If A pushed 50,000 to Department B on that first step, and it said step down, then you'd use 150,000 and then figure out the percent that goes to Y in this case. Yes, yeah. That sounds like you've summarized it perfectly. Yeah. All right, it's 4:15. Get out of here. Oh, sorry. Like I said, I'm going to come back Thursday. You can or can't. It's up to you. I'll go over requests as long as there are some, and then I'll also be here the Thursday after 12 to 2, which is our exam time.